So again, I'm Jean Aboumrad. I'm very happy to be here. We are an international investor. We are based out of Dubai. We deploy our own capital. We have like-minded and close, let's say, family offices who co-invest with us. Till very recently, mainly our markets were Western Europe. We were like in safe havens, and this is where wealth preservation and money was pretty much parked. So we are in London, in Paris, and many other Western countries. And very recently, actually just before the COVID, we decided that we're looking for higher yields. We decided to start looking elsewhere. So we had the choice either to go to the US or to look east. And we fell in love with Poland, which was our first target. And then we decided to open an office here. We hired the team, and we started deploying. And we have very big ambition for the CE region. Mm-hmm. So yeah, in a few words.
So I saw the globe earlier where you're investing. So I mean, why Poland? Why not open an office in the U.S. or bigger markets or some other place? Why exactly Poland?
Well, yeah. Look, by design, I'm Lebanese. I grew up in Paris, and this is our part of the world. So we believe like we are more comfortable, basically, being around Europe. We are from the Middle East. The US is a bit far from us, so we have some investments over there, but we haven't yet decided to really deploy heavily. I don't think this is going to happen anytime soon, and we feel more comfortable actually in this part of the world.
Right. Well, welcome
our neighbors.
Welcome to the region, of course. Dieter?
Yeah. My name is Dieter Knittel. I'm head of CE at the PBB Deutsche Pfandbriefbank, and we are active in Central Eastern Europe for the last 20 years. And it's for us, it's Poland, Czech Republic, Slovakia, Hungary, and Romania.
Great.
Hello, everybody. I'm Daniel Banach. I'm a partner in at Alto, responsible for real estate advisory and the tax M&As. We provide tax, accounting and legal services. We have a very strong presence and expertise in the real estate market. And yeah, I'm looking forward to having had this interesting discussion. And thank you, Craig, for inviting me here.
Yeah, thank you.
Łukasz Białecki. I'm heading real estate financing bank Pekao, one of the largest Polish banks, basically multifunctional bank, but we have very strong corporate arm, and one of its important parts is our real estate financing business.
My name is Wolfgang Mollner. I'm representing Erste Group Bank AG, which is a bank in Austria, headquartered. We are active in CE and Austria. We have a bit more countries, like Dieter has mentioned. We also have Romania, Serbia, Croatia, and a few other countries. We are active in all asset classes, also in Poland, especially one we don't have, which is PRS. We don't offering in Poland. Otherwise, all asset classes and all phases in construction and investment.
Okay, great. Hey, I'd like to just start with a banking question. What a shock, yeah. But generally when there's issues with the banks or they're not lending as much or under different conditions, I never get a banker up here. During good years, all the bankers want to be up, and I really appreciate you guys all being here today because. We're getting a lot of things and even just emails from ask Dieter this, ask Dieter that. Dieter's on your panel. So, but anyway, let's just start with the banking. What's going on and how do you guys see the rest, any more lending this year? How do you see the market next year from your point of view on lending, on conditions? What's dropped out of the market? Is there lending happening? Some people are just complaining there's no lending, and then when I talk to the bankers, they're like, yes, we're lending, same thing. So help us clear this up.
Yeah, of course. I mean, it's always the question who you ask, right?
Yeah.
Because of course, I mean, banks normally, I mean, they behave quite similar, most of them. Mm-hmm. So because, I mean, in more difficult times, I mean, we are then looking for, I mean, more conservative structures. We're looking for similar products. And of course, I mean, if you're exactly in that range, also from a client perspective, you're there and you're happy because you still face competition. Unfortunately, if you are outside of that range, which is narrowing in difficult times and broadening in better times, I mean, then of course you complain, okay, banks are not lending. Yeah, so it always depends a little bit, and that's where we are at the moment. Of course, I mean, overall the situation is not easy, yeah, because you see an environment with a lot of shocks and things you did not foresee before. But I think we are managing it in a way that, I mean, we are talking to each other, we are here, we are lending, yeah, and as Wolfgang said, I mean, we are doing this for such a long time, and we understood, okay, what is the current situation and what we have to do. And that's why, I mean, everyone is talking to clients about potential transactions. And I mean, if you see what has happened, I mean, in the last 3 quarters, I mean, there are a couple of transactions in all asset classes. Sure. Yeah, and that's what you see. You see it on the office side, you see it on the logistics side, you see it on PRS side, even on the retail side. Yeah, especially on convenience discounters, you see transactions, and that's why you see market activity. And also, I mean, there's no bank who is saying, okay, they stop lending. I mean, that's what we don't do, and that's what we will never do. It's just that we say, okay, well, in terms of leverage, I mean, of course, right now it's more in the range of 50 to 60%, but still, I mean, on development loans, I think also you are probably still in a range of, I don't know, 60 to 7% LTC, yeah, where you say, okay, well, this is still something if you have a certain pre-lease, for example, in place. Right. Yeah, so overall, I mean, banks they understand, okay, how the situation at the moment looks like, and that's why they adjust their strategies accordingly.
And Łukasz, when you hear Dieter, it doesn't sound like much has changed on the banking side. But when you're talking to the developers or investors, are like, "Oh, no bankers are answering my call." What's changed, if anything, on your side and on the banking?
Okay, first of all, we still pick up calls. I can confirm this.
They didn't say you particularly. Just
I know.
In general, they're
so no,
complaining
basically,
about it.
we still pick up phones. I would say as following. Europe is entering more or less a recession phase. We have very high interest rates. So as a rule of thumb, this is a time where banks are a little bit more cautious about lending. We are not even speaking about real estate. We are speaking about banking sector. This is what we are taught on the first years at the economic university, that at certain times the banks simply decrease lending. This is one of the reasons why the economy is going a little bit down and why it's cyclical. I would say at following that in terms of lending in real estate sector, I wouldn't say there is no lending. There is lending. I think the names of the banks are still the same which are lending. For sure, everybody is struggling a little bit more with structuring because of the higher interest rates. So simply, it's a little bit more sophisticated to create structure that are acceptable for everybody. And I would rather say that at this point in time, it's more challenging to find a structure which is acceptable both for the lender and for the investor. But in terms of like appetite of the banks, I wouldn't say it dramatically fallen. And as Dieter said, even in construction sector, which is maybe sometimes a little bit more tricky, we were always doing this, we are doing this, and we will be doing this in the next 2 or 3 years for sure. So as far as the projects meet the criteria, and of course, as far as the sponsor is okay for us, or especially if we have a long track record with the sponsor, we are more than happy to lend, and we will be doing this for sure.
So the conditions are changing a little bit. Obviously, interest rates are a bit higher, so the banks, well, it should be good for the banks, right? You're making a bit more money as well.
It's a little bit more complex because, you know, banks are on margins, not on interest rates. So if the market shifts, I know that in Eurozone it's a little bit maybe still different, but if we come to this magical level of 2.8, I think today, which is current swap for euro, more than sure all of us will ask us individuals, our banks, to pay for our deposits. Right. So I wouldn't say that it will transfer immediately into great revenue
profits,
from the banks.
Yeah.
Yes.
Okay. Wolfgang?
I can add not more than that, because I think most of it has already been said. And one of the biggest topic is, as Łukasz mentioned, figures are completely different as it has been beginning of this year. So interest is an issue, exchange rate is an issue, service charge is an issue, construction costs are an issue. All of that figures are completely different to that what we have seen years before, not only months before. And that has started not only with this war, it has started this year is started that all these topics came on the table at once, and that makes calculations on our side, but especially on the side of the investors or developers, complicated.
So okay, we brought up the war. How has this actually impacted the way you guys lend? What is actually, I mean, I understand everyone's a bit nervous, but has anything actually changed that's, you're like, oh, we're not lending on that because the war is, 500 miles away or something?
The war is close. It is
Always more risk. Yes, of course.
No, but I mean, you have overall the risk. I mean, but this is really affecting whole Europe. Mm-hmm. I mean, of course, you have long discussions. I mean, if you're preparing your credit application, if you're discussing this in credit committees, of course, you're asked much more questions than before. You're doing much more analysis, due diligence. I mean, you have done this, of course, also in the past. But I think right now, of course, there are a lot of discussions. And everyone is cautious. I mean, that's definitely what you see. But I mean, of course, the biggest issues also for the banks is, of course, I mean, that's what you said, is funding cost. Yeah, because I mean, it's overall liquidity. Mm-hmm. Because ECB probably did, I mean, they reacted in a way probably where you could have said, okay, they should have done this all a little bit earlier. And right now, that was also a situation where then all of a sudden they increased interest rates. They reduced substantially liquidity overall in the market, and that had a big impact on the bond market. And of course, that is also affecting banks, because I mean, overall, the price for liquidity increased quite substantially, but also for clients which were active on the bond market as well. So that's why liquidity overall shrinked, and that is, of course, the biggest issue, and we have to digest that. But I think we do this in a way, as usual, that we say, okay, we are budgeting then. I mean, we have certain amounts and liquidity, but of course that was substantially reduced. Yes.
Right. And Daniel, just coming back to you, because it's kind of listening to Jean say, oh, we love Poland, but over the last couple of years, I'd say even the government here has kind of used the real estate as an ATM machine to make money for them, and they see it as a huge cash flow. Do you see that continuing, or do you see some opportunity as the government kind of looking at this like, hey, maybe we should be a little bit more friendly, investor friendly, a bit less tax? How do you see that as looking into your crystal ball for tax?
Yeah, so that's a very good question, Craig. And yeah, indeed, I mean, Poland was historically and still is a very attractive market for the investors. We have a very favorable demographic, big population, relatively high number of well-educated people who are available to work. And the taxes, and in general, tax environment was not, I would say, a factor which was treated as the thing which could attract the investors. Mm-hmm. It was historically, but during the last few years, I would say that the changes in the tax law were adversely affecting the real estate sector, and I believe that this mindset needs to change in the future, and the legislator should again treat the tax environment as one of the incentives for the investors to spend their money here. Mm-hmm. We have a very uncertain geopolitical situation, so I think that that it should change, and we do see some first signs of that. For example, the minimum tax for property was suspended for 1 year. I could bet that it will be suspended also for 2023. We have a very interesting investment vehicle being introduced, so Polish holding company. But I think that for the time being, it's too little, too late, mm-hmm. and I would advise the government to speed up a bit here.
Right. Well, I think all governments in the world need money at the moment, right? Mm-hmm. And I guess it just depends on the sectors. I was just watching the BBC, and they're trying to tax Shell and BP for making tons of money on profits.
Yeah, we had those ideas about windfall tax, for example, which was proposed by Mr. Sasin. Mm-hmm. It wreaked havoc on the stock market, and now the government is saying, okay, well, we will reconsider this, but yeah, the damage was already done.
Yeah, well, he's in charge now, so I guess he's looking for money. And of course, we're happy to take any questions or any comments throughout the whole program here or throughout the whole conference. So if you have any comments or comments that you want to make, please just raise your hand, and Gosha will hand you the microphone, and we'll cover anything like that. Okay, so you see, tax issues are slowly changing. Let's say a little bit more friendly, yeah.
Yeah, I would say that, but again, I think that the pace is too slow actually.
So for foreigners coming into the market or anyone looking at new properties or new projects, in 30 seconds, how would you structure them? From a tax, let's say, point of view, what are some of the basic startups?
So I would say that the typical structure involving real estate would include a Dutch holding entity, which would hold a Polish either holding, and which in turn would hold a Polish PropCo. The Netherlands is still quite popular destination for holding entities because you don't have the real estate clause yet. In the double tax treaty, so any return on the exit would not be taxed in Poland. It will change probably next year. Luxembourg is still used quite often as a holding entity, as the holding jurisdiction, but in general, I wouldn't say that the way that the acquisitions were structured will change substantially in the future. What we see is that most of the exit are now through asset deals rather than share deals. The reason being is that you can still effectively achieve a debt push down in Poland using this exit strategy. What is interesting is that starting next year, the restrictions on deductibility of interest will be eased a bit. So basically, you can get an interest deduction if you fund the acquisition using external debt, so bank debts. And I believe that this may be a factor which will kind of push the investors to use more external debt. Of course, there is a question, how much deduction you can absorb at the entity, but yeah, I wouldn't say that we are structuring the transactions in a similar way. Polish holding companies, new vehicle, quite interesting, and I believe that it will be used more in the future. But most of the investors are still quite conservative. They already have their investment platform set up, so I think that it will stay the way it is for next year and another.
Right. And Dieter, from your guys, the bank's perspective, is there sort of it could be all of Europe, let's say. Is there A-list? What are the A-listed countries, B-listed? Where are you looking at first to lend money, or what kind of where would you prefer?
I wouldn't say that it's really differentiating between countries. Of course, in CE, Poland is the dominant market. Yeah, it's the biggest one. On the other side, what you can see is that, really still Poland is lacking really Polish capital. And that's really a pity, yeah, for the last couple of years, because you see much more stability in Czech Republic or Hungary, because there you have a lot of local funds, local money, and they are always there. They are also looking for smaller transactions here. If you see over the last 20 years how the investor base looks like, probably each year you have different investors being quite active in the country. Yeah, for example, at the moment, you have a Czech money, you have Hungarian money, you have money from the East, you have a lot of money from Israel at the moment being active, but that was before Corona, that was completely different picture. Yeah, but still Poland is lacking local money, and I think that is something what is needed also to bring a lot of stability also to the Polish market. Yeah, and overall I would say that I think financing is not the issue. Of course you have higher financing costs, and probably leverage went down a little bit, but I think it's really at the moment the biggest issue is that because you have, a year ago, you had probably overall financing cost of, 2%. Yeah, it was mainly the margin. And right now we're talking about 5%. So 3% more of financing cost right now to digest. And that's why you need a substantial change in terms of prices, asset prices. Yeah, you need, and that's something at the moment, and that's
meaning they're coming down, or
no,
probably,
but you need, of course, you need the buyer and the seller. They have to agree on certain prices, and that is something what, especially in the prime sector, where of course also banks would love to be there because they like green assets. Completely new assets, but at the moment that's more difficult. That's why a lot of clients, they are looking for the region, for example, in Poland, where you have higher yields. They are looking for Mokotów, for example, where you have higher yields. That overall it makes sense. But in the prime sector at the moment, this is really a wait and see situation. At the moment, there is nothing happening because first of all, they have to find the right price, which is not yet there.
Right. The sellers expect something, and now with interest rates a little higher, it's difficult to get to that number.
Exactly. But if this is then acting again, it's the same on the retail side. I think no one would say, okay, well, shopping centers, they are not working. Of course, there are some of them, and probably they will have difficult times. Yeah. But overall, it's really the overall sentiment of retail and shopping centers where all the investors are saying, at the moment, we are not touching it. Yeah. And that's why at the moment they are not, it's mainly discounters, retail warehouse, but not shopping centers. And probably that will change, but also that means, a major yield shift also in terms of shopping centers as well.
Sure. Okay. And Łukasz, to you, just on you were talking about lending and on construction loans or development loans. What sectors are you getting more interest in, or more applications for? Or
of course, for many instances, still the hottest sector are warehouses. For sure, there are still a lot of developers who are willing to invest in warehouses in Poland. I think also there's a fundamental need still for Poland for warehouses. Plus, what I think is still not on the market but will come. Is that there will be a little bit of change in the, let's call it, roads in terms of logistics, because I think there will be more focus on the warehouses on the road to Ukraine, simply because a lot of space will be needed for the reconstruction. So I think southern Poland or the road to Polish ports, etc., which is a natural way of developing some materials to Ukraine in future for the reconstruction. This will be also a places where warehouses will for sure have their moment in coming future.
Yeah, there is about 20%, I think, of the warehouses that were destroyed in Ukraine, so they need to open somewhere.
Plus, for sure, those are, if you want to rebuild the country, and I really believe Europe will rebuild this country after the war, which is hopefully won by Ukraine, which I also strongly believe. You need to store somewhere all those stuff, and probably, Ukraine after all won't be the perfect place. So a lot of those warehouses might be simply quite important strategically for the upcoming years for this reconstruction. So warehouses for sure. With offices, I would say that the market is quite calm. Everybody would like to build office in city center of Warsaw for sure, but of course, permitting, etc., there aren't too many projects ready. So I would say that we would be more than happy to finance construction of offices in Warsaw, but simply projects are missing. In the regional cities, there aren't too many, or there are less for sure office construction. In terms of retail, big shopping malls, there's hardly a place for any big shopping mall in Poland. Retail parks are quite a nice business, a lot of them being constructed. Plus, there are some interesting opportunities which are come to us in terms of PRSs and student houses, where, of course, the currency is a little bit of a challenge because this is rather PLN market as of now. But there are many interesting things happening right there.
Right, because all the rents are in PLN, yeah?
Currently, or the rents are in PLN. Yes. Currently, this is PLN, or the projects are PLN currently.
Right, okay.
But that's the issue, right? Local interest rates are extremely high. Yeah, WIBOR is at 7%, and then plus margin, you're close to 10%. Yeah, and
I would say yes, but this is also what you said about real estate pricing. But this is also timing issue. In Poland, which is like a very nice example, you have 10% interest rate. 10% meaning with a margin you have to pay 10%. But at the same time, you have 20% on close to 20% inflation, and rental prices for flats close to 20% per year. So it might not be an issue of figure, it might be a timing issue. Because of course, if you have a hike in interest rate in Poland from 0 to 7 in terms of the national bank interest rate, and you have 20% price increase, you need to go through the 20% price increase 2 or 3 times to get to a place where you can service the interest. But still, in the long run, the figures add up. But of course, this is like a timing issue.
And John, I saw in the presentation that you have several banks that you're working with, and I saw some in Spain, and of course Millennium, and a few other banks. So, what do you see changing in the banking from a customer point of view or client point of view? What do you see changing, and what do you think's how do you think the projects going forward are gonna look?
Yeah, look, we are lucky enough to adjust our investment strategy because it's a captive money, so we are not bound by a lot. We have a lot of rules and corporate governance, but we can adjust our investment strategy based on the financing and based, on the market conditions. So, and we have some cash-on-cash requirements for our shareholders. So we try to manage, our portfolio based on that. So basically, till now, we were mainly looking for yield-generating assets, looking to put as much leverage as we can, and we were quite successful doing that. But we always have this conversation with our shareholders and investors, and people get used to the cheap money. People get used to, to very low interest rates. But you cannot tell. But I'm old enough to tell you that I have done. I have lived in a world where the LIBOR was at 7. And this was during the 90s, and I used to be a banker, and we used to do business. And the first mortgage I got personally, it was at 7% interest rate. So now everyone is pretty much complaining because they get used to get a mortgage at 1.
Yeah.
I'm talking about Europe, but guys, we started at 7 and even more. In the late 80s and 89, LIBOR was around 10. So, my point is that we have lived in this world before. People tend to forget there's a cycle, and we need to adjust. The beauty of what we are doing is that it's our own money, so we can adjust. We don't have to report to LPs. We can, if we have to delay our yield investments and delay a little bit the cycle to go more into value add or opportunistic, we can still do it. So it's pretty much our code. So we have very good relations with actually it's great to be next to bankers. You want to be with your bankers and tax advisors. This is for an investor, you are in a very good company. So for the time being, we haven't suffered yet. Obviously getting financing in euro is still makes sense. Hedging is a bit more challenging for us, hedging our interest rates. And zloty is slightly more, more challenging, let's say. But the thing is, everyone is betting on the inflation, actually. So everyone is expecting that, our lease will have the inflation, and seems to me like everyone would like to take part of this. Where we investors took the risk on on this. But so far so good. Let me say, for us, it's so far so good. And again, we can adjust by countries, but we haven't yet felt there's some stress on the loan to value. This is banks are asking us more equity, but which we can live with.
Because you're definitely more flexible.
It's probably just the speed, right, of reaction. Also in terms of interest rates, because I fully agree. The interest rate level, what we have, or what we see right now. this is something what is not extremely high, but the speed of changing, right? And all of a sudden there was the war. All of a sudden, within 2 or 3 weeks, you had a substantial increase of interest rates by 50 basis points or so. That is something you haven't seen in the past, right?
No, it's true. We haven't seen that, and we came out of the COVID, so it was already a challenging situation for all the investors, and we had this period of uncertainty. No one knows where we're heading for. And then just after that, when we start a little bit stabilizing, say, okay, it's not the end of the world. Let's, go back to business. And now we have the war. So, it's very challenging. But I think, the market takes some time to adjust. And because we are buyers, but we, pretty soon be sellers as well. So I understand. But people and sellers and their advisors, they take some time to adjust, on the yield. So the asset the pricing is going to change anyway. So now the question is, should we wait and take the risk of higher interest rates, and so we end up with the same, cash on cash or margin, or should we go now? But again, we feel this because we are also in France. We are London is a bit challenging now, but we are in Germany. We are in other let's say more, not gonna say established, but where interest rates are still lower. So we haven't yet suffered honestly from that. This is the point.
Yeah. No, but it's also the same on us, because you asked about countries. Mm-hmm. I mean, for example, talking about Q1 budgets, I mean, they are really split equal between the countries. So we have the same portion of transactions we are doing, for example, here in CE, same as we do, for example, in France or UK. It's not changing. Yeah, so that's what I'm saying. It's a European approach. I mean, the budgets are where they are. Yeah, so because of overall less liquidity available in the market, but in terms of country split, there is no change or differentiation between Poland or Germany or France or UK. So they are really more or less the same.
So just clients and deals, whatever.
It's mainly clients, and that's why it's great to have you here and others, that you see, okay, because what you need is you need market liquidity. And the best thing is in all asset classes. And then banks also feel happy and they are fine, because, I mean, they see, okay, there's liquidity, they can exit at a certain point of time, and that's what they want. Yeah, and that's why you need, and that's also why it's great to have a different base of investors. Yeah, if you have just institutional investors from abroad, for example, from Germany or France, that's also not healthy. What is good is, I mean, that you have for each asset class, for each sector, whether you have opportunistic or value add or core buyers, I mean, that you have also in each sector, you have really activity, and that's what you need, and that's important.
Yeah, and as you mentioned, Czech investors or Hungarian investors, they haven't slowed down at all. If anything,
exactly.
It seems like they're just doing more because there's not the investcos in the market and those kind of.
No, exactly. The only question is, okay, what is their requirement also from their investor base? Mm-hmm. Yeah, because, I mean, of course, we discussed it yesterday. At the moment, you can easily also put your money on deposit in local currency, and you get. Łukasz, you mentioned these lovely
inflationary bonds.
Inflationary bonds. Unfortunately, we don't have it in Germany, but for example, you can do it here. And if they are inflationary adjusted, I mean, you can easily earn then, 10%, 15% returns. And of course, I mean, if you could do this at the moment, I mean, that means also as an investor, I mean, that is something what could be easily done. And if you are then guaranteeing, 5% on real estate, or you can deposit in the bank account in local currency, of course, the question is, okay, what would you do?
Right.
Yeah, but I think one thing that needs to be mentioned, I wouldn't underestimate the fact that in countries which, let's call it, more volatile currencies, it's not only about return, but also, this is a little bit potentially like from countries run to euro, which is still very stable currency in comparison to other.
No, that's right. That's right. That's right.
The question is how much you can buy for this Czech koruna or Polish zloty in 5 years. So I would say that, comparing this is, I think currently it's even much, 2-3 years ago, there wasn't a rush into foreign currencies because the inflations were low everywhere.
Yeah.
I think now there is a preference, at least part of the portfolio, to have a more, let's call it, stable currency. And for sure, the bigger the currency, the stablier it is.
No, that's right. But Czech koruna, for example, was always quite stable, and it still is. And also Zloty, I mean, it weakened, but at the moment it's also in a band. It's not going higher than 4.9 or 5.
But inflation, of course, is double-digit in both countries.
Exactly. Agreed.
Which, of course, long-term affects currency. It has to.
And of course, like I said, any questions, raise your hand. If there's no questions, I might start calling on people as well. So be ready. Take some notes. Jane, you mentioned... Oh, okay, over here. Oh, sure. You can have this one. People don't want to hear me so loud.
Just very quick one. Wouldn't be the solution to also accelerate a little bit this rebalancing period or the expectations of sellers versus expectations of buyers to be a little bit more flexible on the hedging requirements on the when we close the financing? Because you know.
So what do you mean by flexible?
Because when we are. Yeah, you know, the typical requirement would be that you ask 70% of the loan to be hedged fully for the full period of the time. Wouldn't it be interesting to propose some structure in which it could be hedged, for example, for 2 years or for a short period?
No, you can do this. For example, then you do a 2 + 1 + 1 + 1. Yeah, that's what you can do.
Just to, let's call it, survive this period.
No, that's right. That's right. But that would mean then you have after 2 years an extension option. And if certain parameters are fulfilled, then it would be extended by another year, and then you would hedge. The only thing is, of course, you don't know at what level at that time, and then you have to be prepared to invest further equity just to be in line with covenants. But that's what we are doing.
I think,
of course, the question is whether it's. I mean, but this is, of course, the question overall. Yeah, and probably we would say, okay, do you really want to face that risk? But if your opinion would be in that way, and you have sufficient cash,
I would say that we all face the same discussions with clients. I think we all try to be flexible in this respect. But I think the borderline is that 5 minutes ago we spoke that the volatility of interest rate is unprecedented, and now we are speaking whether it's not a solution to stop hedging them, which is a little bit counterintuitive, as for sure from banks' perspective. Because to be honest, I think now this is more preferable for banks to hedge even more than 70%, because we see the volatility. We hope it ended, but nobody can save us for 100% that this is the end of the volatility of interest rates. So
no, that's right. I mean, at the moment, interest rates will increase because ECB will probably, or I don't know whether they have done it already, but they will do it today. And yeah, they will. And then in December, probably again. Yeah. So that's what you see. But overall, yeah, of course. I mean, a lot of clients, they are saying, okay, or can we reduce the percentage which is fixed, or probably buying a cap or collar or whatever. I mean, yeah. But I think the most important question is, okay, what about the asset? I mean, what about the fundamentals? And then hedging is an element to discuss, but normally we find a solution also on that.
Plus, I think we all had those discussions, the clients asking, okay, the swap is 1%, it cannot be higher, let's not hedge. Then when it was 2%, it's 2%, we don't swap, it cannot be higher. And now at 3% we are having these discussions. Personally, I think we are close to the max, or I think it might be even lower, now it's even below 3. But as said, unfortunately, I would say that even what is the biggest problem for the banks, I don't know whether you agree with me, is not the current market, but the volatility of the market. So it's no matter what is the interest rate, no matter what is the valuation, no matter what is the rent, no matter what are the things, from bank's perspective, of course, if there is liquidity on the banking market, you can always propose something to the client. The question is whether for the client it makes sense. But much bigger problem in offering to the client a structure is the volatility, because if you start discussing now and you are super fast and you close within 1.5 months, 2 months, which is quite fun for a bank loan, it normally takes longer, you might be in a different world. So the challenge is even not the market, but the volatility, I would say.
No, that's right. That's right. But then, I mean, you have to discuss again, and then you have to adjust the structure accordingly. Martin?
I'm sure you have a question. You have a question for Dieter, I assume.
No, just a comment.
Answers, yeah. Answers.
It's fine. It's fine? Yeah, we understand you.
No, for me, the question is, I mean, I fully understand the question regarding the hedging here, but honestly, wouldn't it not be the better way of adjusting the yields of the properties so that you don't need the, let's say, flexibility on the hedging anymore? Because why do you need a flexible hedging? Because otherwise you can't make your returns. Yeah? And for me, the right approach would be that the market values, the yields have to change. Yeah, this is what has to happen. This will happen, and then you don't have the problem of the high interest level anymore, and you don't have the problem of the hedging anymore.
No, that's right. But I think we don't have sellers in the room, or do we?
No. But you are so right, and this is why I said at the beginning that it's there's always a timing for the expectations and the people to adjust. And so we are in the middle of this right now as we speak. I mean, we are in the middle of the situation, and we can see it in all the markets where we operate. So expectations from the seller side are still very high. The buyers are looking for opportunities. The money at risk is the risk reward. is totally different. So we feel that we are taking more risk, and as such, we need to be more remunerated, which is very logic. So, but this timing, we are in the middle of this right now, and meanwhile, we would love to keep deploying capital because, well, a lot of investors have still capital to deploy, and the hedging is always. I mean, we always, have to take this into account, and sometimes in our simulations, say, okay, why don't we, why? And it's also your expectations on the interest rates. It's a cycle. So at the end of the day, we do not expect this to last forever. And if we're gonna really truly go into recession, I'm pretty much sure that the central banks will look at at the interest rate from a different angle in not very long time. So I mean, all the comments are right. It's a problem of markets. It's supply and demand, and who needs to sell at which price and who wants to buy and at which price. And in the middle of all this, you have your lovely bankers next to you, and you have to deal also with them. So helping you exactly.
Okay, I guess it's time to mention ESG, Greg. Sorry for that. It's much too long, you guys talking and not mentioning it. So, according to McKinsey, we know that the average portfolio, and what I learned, the most of lending today happens on the transaction market, not so much on the developments, clearly. So such a mixed-use portfolio losing 40% of its value by end of the decade. That makes 6 years from now. If we do not rolling out mitigation actions towards ESG compliance, in this term, I guess it's much more meant invest to retrofit these buildings to be kind of complying, because you can't make an old one to a new one, of course, but you can work with that, right? So knowing that now, and knowing that out of my talks, out of the panels, that the bankers do not have such carbon risk real estate monitoring implemented yet, my question is, how do we deal with this? If we know we are lending now for 2 or 3 or 4 years on whatever loan to value ratio doesn't matter, and we see that the legislation, EU taxonomy comes into place, and the investors on the exit side refusing to invest in real estate which is not ESG compliant, that for me makes a transformation risk, and not if the interest rate is 8 or 10, or if it's volatile to a certain currency on 10%. Because we're talking about the asset, the core, what is financed, what is appraised here, right? Not about the market circumstances. So the market circumstances can switch every day, but the asset remains the asset. And to give you an example, yesterday I spoke to an equity fund. They are opportunistic investors, and he told me London downtown was £1,200 a square feet, which makes 12,000 a square meter, which is a good price. But now it's offered already on 650. And that only can have 2 reasons. One is that this financing is ballooning and comes for re-extension, and they do not have the necessary equity, or there is an ESG risk, because the London market didn't change, right? So what's your take on the ESG?
I think you have mentioned ESG, and we haven't spoken about it, but it's one of the top topics of banks as well, meaning it's clear that it is on bank side as well. The banks are, and I think all banks are having their ESG monitoring. All banks have an internal or external ESG rating. So this is one of the big topics what is for banks on the financing side. We have spoken about market, but ESG is one of the big topics, and the banks have, of course, realized that. So that's clear. And if you speak to banks, they will also ask you, do you have an ESG rating? Do you have information on ESG? They are asking you for that. So that's kind of normal or standard what we are having in the banking world now as well.
But Wolfgang, if this is true, you can't finance 80% of the properties anymore because they do not comply to ESG.
You have to find ways to finance properties, and you have to find ways how much you can fulfill ESG criteria as much as possible. You will never can do 100%, but it is a topic, and you have to try to fulfill it as much as possible, because you could, as you mentioned, you could not say 80% are out and we are not considering that at all, because what should happen, this is a transformation process and takes time. Yeah.
So how many, talking about ESG, so how many, and this could be for other bankers, how many, let's say, percentage of deals fall apart because they're not enough ESG compliant, or they're enough where you're saying, wow, this is really a big risk?
No, I mean, there are a lot of older buildings, yeah, because, I mean, at the moment, of course, also clients asking for refinancing. And, I mean, of course, ESG is there an important topic, or you can just say, okay, what are your investment plans to keep it at high-level standards? I mean, you know, I mean, always if you, because, I mean, ESG is just, you know, it's a lot of different criteria. But overall, I mean, what are you really investing in your asset? Yeah, and then I think a lot of transactions, they are not happening. Yeah, because, I mean, there are older buildings, and that's why you have some banks, they are just focusing on new buildings, for example. Yeah, or they are just saying, okay, well, if you don't have a clear plan, we are not financing it at all. But of course, you don't see it, because, I mean, normally each transaction is financed by a bank, but right now you will see, because, I mean, there are clients who were active on the bond market in the past, right now they are looking for new bank financing. And then you will have the discussion now whether it's really possible to finance them or not. Yeah? And then they are forced to do that. And of course, it's an important element. We are discussing also interest rates, because that has a tremendous yield shift at the moment. It's not that we are saying ESG, but ESG is something which is important now, but also which becomes important over the next couple of years. And it has a big impact on the value as well. But at the moment, a yield shift, or interest rate increase by 50 or 100 basis points, of course, that has a direct impact now. Yeah, that means that your next valuation will have definitely will have an impact, or will change quite significantly. Yeah, and that's why we're discussing interest rates at the moment.
But look, from an investor perspective, to be extremely transparent on the topic, even irrelevant of what are your own belief about the ESG and how this should be implemented or not, or what's the time frame. The thing is that we are led by this for two reasons, and it's pure mercantile and investments. So first of all, we need financing, and the banks are asking more and more. So the more certifications you have, you have BREEAM and so on, and all the certifications. We have witnessed this everywhere, that you are getting, let's say, more competitive financing. So we need to look at all our assets has to be certified, because we believe in the ESG, but because also we need to get cheaper financing or better financing. Moreover, when you come to the exit, more and more investors like us, or even funds, you have to be also, compliant, ESG compliant. So it's kind of leading us anyway. We don't have, as an investors, we don't have the choice to avoid the topic. It's embedded in our transactions, and it's led really by the banks and by let me say, other funds or other people who are more advanced. More funds who are more advanced, like than us as as family, family investor.
No, but it's at the moment it's mainly institutional investors, and they have clear restrictions and clear guidance from their investors where they can invest and where they can't. But also some tenants, for example. Yeah, so if it comes to buildings, some tenants, they say, okay, what kind of certificate you have, and this is not at a standard what they want. Yeah, then they are not coming to your building, and then you are losing tenants. And if this is the case, and this is coming at the moment, and then definitely they are investing. The only thing is, at the moment, they have higher service charge. Probably after Corona or during Corona, they had to fight with tenants about what about their rental prices. So at the moment, it's a lot also for investors and asset owners. What you can digest. And right now saying, okay, well, you have to invest another 5 million euros for ESG compliance. Of course, it's difficult, yeah, at the moment at least. But overall, I fully agree. It's something what all banks are asking for and what is needed, especially if it comes to older buildings.
All right, great. Any other questions from the audience? Maybe maybe Marek Kożarek will call on you because you've been listening, and as your business really depends on transactions, I think alone, right? If there's more transactions, you're making more money. Less, there's less.
True.
So, is there more transactions these days? And if not, what seems to be killing it?
No, that's an interesting question, Craig. Thank you very much for, because
There's no free tickets to this conference.
if you look to the overall volume of transactions in Poland, it's exceeded 4.2 billion. It's not bad. It means that for the whole year, quarter to quarter, comparing to last year, it's 20% more than last year.
So you must be
Right?
You must be getting rich.
Oh, not bad, but I will comment on that. So theoretically, that's much better. Yeah, but this is driven mainly by 4 biggest transactions, right? Which corresponds to how much? 1.5 billion out of the 4.2. I mean Google. I mean the Generation Park. Yeah. And, okay. So you know what I mean. What I could observe on my account, let's say, is that the beginning, the first quarter was fantastic, the best ever. Then it stopped completely with the war. I had 12 transactions in the underwriting, accepted by the clients, everything. They all suspended. And people came, contrary to what was in the first wave of COVID. In the first wave of COVID, they came back in September. They came back in June, and all these transactions were done. Yeah.
Investors came back.
Yes, investors came back, and nobody asked me to decrease the value of the policy, which means that they maintained the price. Yeah. Then it was a little bit, suspended for some time. The summer was quiet. Now the investors. Now I have several transactions where the investors, that's fine with the policy, no problem with the risk, etc. We are waiting for them to close, and I receive calls every week saying, "Marek, wait a little bit. Yeah, they are still negotiating. They are still discussing." And these transactions do not close because buyers and sellers are quite far from each other in terms of pricing and conditions. When I was in Expo Real, then I discussed with some investors. Usually, I would say that 30% of those investors that I met, they would say, we are open for business. We have money, we want to, no problem with the prices, we will find prices. So this is quite positive, but 70% said, we are waiting. We will not close anything until spring next year, because what we are expecting, I was talking with the investors who enter in the construction sector, so some warehouses, issues, etc. They buy land. They say, I will buy if the price of land drops by 40, 50%.
50%.
40, 50%. Why such a big amount? Because they say cost of constructions, cost of funding, crisis, etc. The residual value of land, the value of land is the residual when you start from the top. Yeah. So then I think it's a question of negotiation between the buyers and sellers, and I think both parties are not ready yet, ready to close. But at the end, I will give you a very positive news, because after Expo, before Expo, everybody was waiting. After Expo, I receive requests for insurance practically every day now. I don't know if this will close, but at least somebody wants to do something. And majority of those people, they say, good, okay, we want to close before end of the year. Why it's different? Because before Expo, I was talking with some law firms. We work a lot with law firms. So they were saying, you know, Marek, normally I had 8 transactions in September to close before end of the year. Now I have 2. Nothing happens. We don't know who will close. People are talking, but not really pushing, discussing, you know, negotiating, etc., but not really saying that they will close. I think this changed considerably after Expo. So maybe people found a common ground. Let's say they discussed, they understood the position of the other. You know, I don't see cash flows, I don't see prices. In fact, I don't, you know, when I was in bank, that I could see much more of that. But I see the effect, so the final value of the policy. So you will know better. But I think the market is now seriously back. But if these transactions will close, we will see.
Yeah, I mean, I would definitely agree with you. I think a lot of people just wanted to see what was happening at Expo Real. It's almost like a market, sort of, if it's going to happen, if we're going to wear masks, if anyone's going to show up. And I think it seemed like there was more people this year than any time I've ever been there. It was quite full. So
Right.
yeah, you're right. It's just the sentiment, I think, getting going. And I assume if they're asking you for prices, they've done a bit of due diligence already and put a lot of work into these projects. They're not asking you at the beginning, they're asking you somewhere towards the end, I would imagine.
Yeah, of course, at least they know from the lawyers what were the problems in the property.
Right.
So it's already somehow advanced. It's not just a question, oh, hello, what are you doing, what you want to do?
Hi, Merrick, give us a price, yeah? They want
We will see. I'm very curious to see what will happen.
And if I can comment on that, because I mean, being involved in tax M&As, I mean, we do have some, let's say, visibility on the market, and I agree with your observation that there was a dip. I would say in the second quarter of the year. Now it's picking up again, but I confirm that in general the deals aren't closing. I would say that some of the investors are adopting, I would say, a wait and see approach. However, I would say that the level of activity, but again, I mean, tax advisors are engaged rather late in the process, did not change significantly. So this might be optimistic, but again, I'm eager to see what will happen in the next 6 months.
Yeah, we noticed a huge difference in business just right after Expo. Everyone came, and I think they just wanted to see, you know, what the mood was, let's say, for the number of people that went there. Well, we're running a little bit low on time now, so we're going to wrap up the panel by just asking all of our panelists for any last comments, any pearls of wisdom, anything we might have missed. We probably missed a lot, but you know, we'll start with you, Wolfgang, and I'll tell you why. Because we had an event in Budapest last week, and
missed out.
And what's that?
And he missed.
Yeah, Wolfgang wasn't there, but his bank won Bank of the Year for SEE region, and several of the developers that had tables, they all stood up and clapped. So you must be doing something with some lending down there as well. So anyway, they were very happy. You're welcome back to Budapest now, it seems, if there was a reason you weren't going. But they all seemed very happy with your bank down there. So I'll let you wrap up with that intro.
With this intro. So, that's great to hear, thank you. As we are having a big bank in Hungary, it is clear that we are very active there and that they are very well known. So it's one of our nice subsidiaries from Vienna. And Pearl of Wisdom is a short one. I hope that it getting that worse what I anticipate, because my personal feeling is it will be recession, and that what we have seen right now is that what will be a bit more standard than it has been before. So that life will be on all sides, meaning investor side, construction side, banking side, more complicated and stays more complicated.
Great. We'll just move down the list there.
No, now to give advice or to forecast anything is quite challenging. But I would say that, summing up our discussion, like for sure we will have 2, 3, maybe 4 years or volatility. And I think ultimately, as we all sit here, volatility is good for us because volatility creates opportunities on our side. So I think, maybe at the beginning everybody is a little bit panicking once the volatility comes, but I think, like I said, long-term volatility means good deals and means opportunities for all of us to make really nice business. Thanks.
I'm really bad at wrap-ups, but I'll try. So, I mean, we were discussing interest rates, volatility, how the market will behave in the future. I think that the word which is kind of now on everyone's lips is resilience. We need to think how to build resilience in our businesses and basically survive next 3 to 4 years. I'm pretty optimistic, but in general I'm a pretty optimistic person, so I'm biased here. But yeah, I think that we should focus more on, I would say, non-financial factors as well.
Yeah, Craig, I mean, it's great what you're doing. Yeah, and I mean, every year if we are here and if we discuss things, I mean, that's the important thing, right? I mean, we all think that we can handle all these issues. I mean, over the last 20 years, there were so many issues we faced. Yeah, Marek, I mean, we have such a long history, whatever we have done, but we are managing it. And that's the great thing. You have so many experienced people here in the room and in the industry. And I think that and that's why I believe that we will also manage the situation as it is right now.
Yeah, we always like to have people on the panel and the audience that have been through several crises and like, oh, they're still there. They didn't run away.
No, exactly. And I remember in 2008 also we had discussions about, okay, how it looks like. And we said, okay, probably it's just lasts for 6 months and so, but we managed. Yeah, we are still there. And also, I mean, we will manage that situation now. Yeah, it's like as we managed also the pandemic. Yeah, and I fully agree. We thought, okay, after these 2.5 years, right now, we have a booming year this year. And then, and then the next thing happens. But of course, if we are through that now, okay, let's hope that we have a better 24 and 23.
When we met for the first time, it was in 98 or 99, if I remember.
Exactly.
Yeah.
It's quite a while.
Yeah, it's quite a while. So in 98, 99, I remember that the interest rates in zloty were 24%.
Exactly.
And it was possible to do it.
So we can be happy. And
what was abnormal is what was after Lehman with 0%
So there is still a headroom, right?
And we financed Warsaw Financial Center at that time.
Yeah, exactly.
And it's still there.
It's still there. Well, it's lower than 24%, right? Yes.
Yeah, but this is exactly what I'm saying, that we got used to this. I mean, we have all lived in situations where interest rates were higher, where we have all lived recessions, we have all lived, crash in the stock market, the internet bubble. I mean, and every time you feel like it's the end of the world, and it's never the end of the world. And there's, not, be very optimistic, but I come from a part of the world where I have lived the war, and I know there's always a tomorrow, and even more than that, we as investors, we tend to grab opportunities. As entrepreneurs, we feel like when there is disruption in the market, we are like very eager to see what's happening. So my point is that I'm sure in 2 or 3 years, the whole scenario, this will change completely. The economies and the population in Europe are very resilient. This is at least our view on that. So we are not very afraid about what would happen. We are very optimistic about we are, let's say, decently optimistic. We feel that there is more a catch up and opportunities in this part of Europe versus Western Europe. We are happy to be here. We honestly, for me, I'm discovering, even though we sit with a lot of partners and bankers and funds, but it's having a different the view from different part of Europe and the world, and part of of the questioning and what people has, investors and bankers and advisors, what they have in their mind. So it's very interesting for us, and we are very optimistic.
Well, I imagine as Lebanese or Lebanese investors, you're saying, oh, there's a war, we better be careful. And then you realize, oh, the war is 1,000 kilometers away as opposed to in the city.
Yeah, no, yeah, you know, it's not, obviously you have to be careful, but when this happens, you know that there's always a tomorrow, and there's always, you know, hard situations, but, you know, we always end up, you know, getting out of this way or another. So, and honestly, it's not I mean, what we are facing today, okay, we're talking about recession, higher interest rates, but I mean, we've been there, done that. We have already been in these situations, and you know, it's a cycle. We just have to, you know, to drive the cycle and wait for this to happen.
Yeah, I mean, I imagine there'd be a few business plans in the trash where they were planning 1% interest, and now they've got to issue it. But in general, there's someone else, right? You
know, it's all about, and I'll finish with this. It's all about the timing. You know, we have also some investments in Africa. And you know, if you look at the, let's see, the basics or the fundamentals, there's, you know, it ticks all the boxes, and you say, you know what, it's a no-brainer. But you know, 10 years later, it's still a no-brainer, but it's not happening. Why? It's a question of timing, and we are, as Solida, actually, we are, let's say, privileged enough we can ride the cycle. We don't have to exit in 3 or 4 years. If, you know, if we are against the cycle and we have to wait 10 years with our asset, we'll hold it for 10 years. We don't mind. So, but this is our situation. It's not the situation of the private equity funds, not the situation of other VC funds, if not to talk only about real estate. So it's all about, you know, the timing and the expectations of the investors.
Yeah, well, every 7 to 10 years, there's a number of investors that come and say, Africa's going to take off now. Everything's, like you said, everything's ready. And then it moves a little bit. It's difficult. Yeah, it's difficult.
It will be another forum. We'll go.
We'll do the Africa real estate next year as well. So, okay, so we'd like to wrap up the panel with that. So thank you all. Thank all our panelists. Big round of applause for our panelists.
Thank you very much. Thank you.